Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about investments, debt investments, equity investments, and how we classify them under GAAP, which is as trading that we're going to sell off and buy really quickly to make a quick profit. Available for sale, that we'll sell if a good deal comes up, but otherwise we're saving for something big that's coming in the future. Held to maturity securities, which are bonds or other debt that we've purchased not because we're going to buy or sell them, but because we want to hold on to them and receive the interest payments and the principal payment at the end of its life. The last one that we haven't talked about yet are equity securities. And there's a couple of things that are a little bit different about equity than any of the other three methods. The biggest difference, and it's one of our key concepts, is the fact that we keep track of equity securities not at market value, not at what we paid for it, but at what happens to its retained earnings account, to the subsidiary's retained earnings. You see, once we hit that equity threshold, which is 20%, we stop thinking about this as just a normal investment. We are now owners of this company, of a significant portion of its voting rights and of the assets that it controls. And like any other owner, we want to focus in on what they're doing with our assets. And that's what we're keeping track of. So like any other owner, how do we track that? With the retained earnings account. As their retained earnings goes up, our assets have gone up and we have more value. As the retained earnings drops, their net assets drop, our assets drop because we don't own as much anymore in that company. So that's what we're tracking. And again, if you can just focus on that key concept, that we're going to keep track of their changes in retained earnings, the rest of this will be really straightforward. So let's take a look at the steps, and then we'll do some examples that will hopefully bring home what it is we're trying to do. But again, keep in mind that key concept, because then the rest of it makes a lot more sense. Let's take a look at the steps. Step number one, we're going to figure out our percentage of the stock owned, and we're really looking at voting rights here. We're not looking at preferred stock that has no voting rights, just a right to a dividend. We're looking for the voting rights and the control of retained earnings. Number two, we're going to multiply the subsidiary's reported net income by the percentage that we own from step one. Number three, we're right to a journal entry. We're going to record investment income for the period if they've got a profit. We're going to record a loss if they have a loss. And then the other account in our journal entry will be the investment account. So we're recording profit and loss with them on our income statement, and our asset account, our investment in the subsidiary, is bouncing around as well. So those are the two parts to these journal entries. The last thing we're going to do is we're going to record any dividend received. It's going to be a debit to cash and a credit to the investment account, not a dividend revenue, which is what we normally do with dividends as they come in, but as a reduction to our investment in this asset. Why? Because when they've had a dividend, their retained earnings drops. Now, we've talked about this already in a previous segment. We've briefly mentioned it here. Let me mention it one more time. Remember, we can only use the equity method if we own at least 20% of the voting stock of a company. Again, we're leaving out the non-voting stock, focusing on the voting rights. You've got to be at that point where you have a significant influence over this subsidiary. And FASB has decided that that significant influence threshold is 20%. So that's where we have to be in order to do the rest of this process. So with that introduction and those steps, we need to do some journal entries. We need to do journal entries just because they're fun, but we also need to do it to cement these concepts. So let's take a look at our company. At the beginning of year one, Acme Corporation has decided that they want to purchase a majority interest in one of their suppliers, PPLE Incorporated. PLE currently has 250,000 shares of common stock issued and outstanding. Now, before we go on to the rest of the problem, how many shares of stock does Acme have to buy before they can treat this as an equity security? Remember, it's based on percentage. We would need to own 20% of this 250,000. So 250,000 times 20%, we would need to own 50,000 shares in order to cross that 20% threshold. So if we don't get above 50,000 shares, then we would have to treat this as a trading or available for sale account until we get above that magic threshold. And we would keep track of their fair value up and down. If we buy it and sell it, we would keep track of those transactions within that available for sale portfolio. The other thing that we would do, which we haven't done yet but should take a second to do, if they were to pay a dividend while they were in available for sale or trading, we would record that as cash coming in and dividend revenue as our income statement account. It wouldn't go into comprehensive income, it would go right into real net income because we really got that money and we'd really get to show that revenue. That's just an aside because we haven't talked about it anywhere else, and I want to make sure that you know dividend revenue really straightforward. Now in this case though, PLE was able to purchase 75,000 shares. They had the money to do it. So since 50,000 was the threshold and they bought 75, we don't have to worry about sticking it in available for sale or trading. We can start out right in an equity account. So let's start with that journal entry to record the purchase of these 75,000 shares. So let's see, 75,000 shares, $35 each means that we paid, or Acme paid, $2,625,000 for this investment. Now, once you reach a 20% threshold, you don't lump these investments together anymore. They get their own account. So this is going to be investment in PLE Inc. And we'll credit cash. So 2,625,000, 2,625,000 purchase of 75,000 shares of PLE common stock. And as part of this, I'd want to include how much I own because I'm going to need that number later. It's that first step. So let's see, 75,000 divided by 250,000 total. Acme owns 30%, and I'm going to put that right here, 30%. And again, this right here is step 1. All right, at the end of the year, PLE reports a gain of $650,000, that's their net income, and they also decided to pay a $100,000 dividend. In addition, the stock price has dropped to $32 a share, and we want to make the necessary journal entries. Well, the very first thing we need to do is get rid of this, because I don't care about market value anymore. It's an equity security, so the change in market value is now irrelevant. I'm only focused on what happens to their retained earnings account. They report $650,000 of a gain. If they have a gain, then their assets go up. If their assets go up, then their retained earnings go up, right? This is what happens with a gain. And since these assets have gone up, my assets have gone up. Why? Because I own 30% of those assets. And if they were to liquidate, I would get them. So my assets have gone up. So what we're going to do is we're going to take that 650 times the 30% that Acme owns. And 650 times 0.3 is 195,000. By the way, this is step 2. And now that I know that number, I can move on to step 3, which is my journal entry. Yes, the best part. Always the best part. And that is, we're going to increase my asset investment in PLE Inc. $195,000, and I would record it as income. Income from investment in PLE. And this is an adjusting entry for net income earned by subsidiary. My last step, step 4, is to record the dividend that we've received. So I'm going to do the same thing as I did up in step 2. I'm going to take that 100,000 times the 30%, because since I own 30% of this stock, I'm going to get 30% of that dividend. So I'm getting a check for $30,000. If this was an available for sale security or a trading security, I would record dividend revenue. But in this case, if they give me money, then that money is not in their business anymore. I have less assets in that business. So instead of recording it as a revenue, I'm going to record it as a reduction to my investment in PLE Inc. Let's see, dividend received from subsidiary. Now, what is it that we're really trying to accomplish with this? Well, let's take a look at a couple of T accounts. So here's my investment in PLE Inc. And I started with $2,625,000. That's that initial journal entry that we did for the purchase of this stock. At the same time, let's take a look at the retained earnings account for PLE, and let's just assume that they had $1 million in there when we bought it. And it doesn't matter what number you use, that was just nice and simple. But let's keep track. So here's what happened. We recorded a debit of $195 and a credit of $30,000. $2,625,000 plus $195 minus $30 gives us a new balance of $2,790,000. In the meantime, PLE has recorded profits of $650,000 and paid out dividends of $100,000. So they end up with $1,550,000. Now, if you look at this, the net change here is $550,000. 30% of that is $165,000. And if you look over here, 195 minus 30 is $165,000. They match. Why? Because that was the whole point. That's what I'm trying to keep track of. Their net assets, as recorded by their retained earnings, have gone up, and I'm recording my chunk of that increase in net assets. That's what we do with equity investments. We're keeping track of the change in their retained earnings and the assets that it represents. This $550,000 net for PLE, that's the amount of new assets that they now have in their asset account. And that's what I'm trying to keep track of, is that number. A lot of students have a hard time with this until they've done it a bunch of times. Hopefully you're feeling pretty good about it. But the idea here, again, the key concept, is that I'm keeping track of my net in assets in that subsidiary. If you can focus on that idea, then the rest of it falls into place. Let's take a look at a couple more examples. Let's say that on February 15th of year 2, Acme purchased an additional 40,000 shares for $33 a share, and we want to make the journal entry to record this additional purchase. So really nothing out of the ordinary. 40,000 shares, $33 a share is $1,320,000. So just like we did originally, this would be investment in PLE Incorporated. And we would have cash going out to pay for this. So this is the purchase of additional 40,000 shares of PLE common stock. And I now have a new percentage owned. And I'm not going to calculate that for you. I'm going to let you do it. But before I turn you loose on that, I want to throw up one additional problem. At the end of year 2, PLE reports a loss now of $250,000. They declare a $50,000 dividend even though they haven't paid it yet. And the stock price on that day is $23 a share. So figure out what that percentage is and then make any necessary journal entries to record the information in that second bullet. You should have started out by figuring out that new percentage owned. So we own 75, we bought 40,000 more. Assuming that 250,000 shares we used originally is still the number outstanding, we now own 46% of the stock in this PLE Incorporated. Now, That's not enough to consolidate. Thank goodness, because we're not ready to do that quite yet. We'll leave that to future accounting classes, but it still puts us well above that 20% threshold. So that brings us down to our journal entries. Again, we're keeping track of their change in retained earnings. So their retained earnings dropped by $250,000. I'm on the hook for 46% of that, so I'm going to take a hit of $115,000. Their net assets drop, so my assets drop. In addition, they declared a dividend. Now, if you remember from an earlier discussion, a dividend declared is legally binding, which means even though they haven't sent me a check, they're going to have to. So I'm going to record a dividend receivable for that $23,000. That's my share of the $50,000. And I'm going to reduce, again, my investment in PLE because I've moved that from one asset account to another, out of my investment in PLE into dividend receivable, just like they've moved it out of retained earnings and into dividend payable. So if I'm keeping track of my change in their retained earnings, then I have to record this drop because of a dividend payable. Fun stuff, right? Lots of fun journal entries, lots of exciting things going on. What we want to do to wrap up our discussion is take just a minute and talk about IFRS and how it's different than US GAAP when we're talking about investments in subsidiaries or associates, as they call it, under IFRS. Investments in associates or equity stock have to be classified as non-current assets, and they have to be listed as a separate line item. Now, you can lump several companies together. If I've got 3 subsidiaries, I could lump all 3 subsidiaries together, but I have to have a separate line item for this investment in associates on my balance sheet. In addition, we have to show that profit or loss on our statement of profit or loss. We can't just hide it away by lumping it in with something else. US GAAP, you can maybe get away with lumping it in with something else, but you can't under IFRS. It has to stay separate. Now, those are pretty minor differences. The biggest difference is this last one, and that is under IFRS, both the parent and the subsidiary have to use the exact same accounting methods. Now, since we don't require this under US GAAP, if I had purchased 30% of your stock and you use double declining balance and I use straight line, that's fine. I still just add in the profit from you and I'm good to go. Under IFRS, if I use straight line and you use double declining balance, I would have to come back to you and say, no, you have to change to straight line because you can't be using double declining balance and me using straight line. We have to do the same way. So you're going to have to switch to match mine. Well, this has become a big burden on companies. In the US, if I have a parent company in Europe or Canada or Asia, then I'm going to have 2 sets of books. One for my shareholders here in the United States that follows US GAAP, and one for my international stockholders that follows IFRS. What this means, and this is our key concept from this IFRS difference, is the fact that there are companies in the United States right now that are having to follow both US GAAP and IFRS because they have parent companies that own at least 20% overseas that are under IFRS and have to have numbers that match exactly the methods and the principles that the parent has chosen. Now, this is one of the reasons why there's a big push to switch us from US GAAP to IFRS or to hurry up the convergence process because this is an additional burden. It's a burden on the subsidiaries to have 2 sets of books. It's a burden on the auditors who have to be able to check both sets of books. And it's a burden on parent companies around the world who have to make sure that their subsidiaries who follow US GAAP understand IFRS properly so that they can report the proper numbers for use in this part of the accounting process for those parent companies. So that's why it's one of the big reasons why, not the only reason, but one of the big reasons why IFRS and US GAAP are being pushed to at least converge, if not see the US convert to IFRS. Now, investments have become a huge topic, and we talked about why they were so important. Hopefully, if you followed the steps that we went through, you're feeling pretty comfortable with the way we account for these investments. If you'll just remember those key ideas that we want to compare the historical cost to the fair value and put that in our fair value adjustment account for both available for sale and trading. And that in an equity account, we want to keep track of their change, the subsidiary's change in retained earnings. You'll be good to go. Those are the keys to success when recording investments. Now, that wraps up most of our discussion on assets. We have a short little lecture on intangibles that you can take a look at later. But really, we've essentially wrapped up our discussion of assets, which means next time we're starting a new module. I'll see you then.